choose the right investment for your financial goals? Financial Planning 101, a roadmap to achieve your financial goals, episode number 9. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision so that you can reach your financial goals faster and smarter. How to choose the right investment for your financial goals? To choose the right investment for your plan, definitely it is going to be a important job for you. A specific question, specific investments, what to choose. It is a very simple exercise by which you will be able to achieve this. That is, step, identify what is the time horizon for your financial goal. If you are saving money for your kids' future or your retirement, or you are saving money for buying a car, buying property, how many years from now you are going to achieve that goal? This is the step number 1 question you have to answer. Second, what is the cost of your financial goal? What is for education? What is the cost of that education today? What is the cost of that car today? What is the cost of the property today? Get the present value of that particular goal. This is the step number 2. Step number 3, what kind of investment instrument you are going to choose so that we can come to an idea what kind of a return this particular investment can give you. Clear? We will discuss about different instruments giving you different expected returns. We will discuss the coming slides. Step number 4, how much monthly investment you have to do this goal. Based on these 3 input, we will be able to arrive at the 4th number. Doing this calculation may sound a bit complicated to you. How can I arrive at the monthly investment? How should I invest? I'm a bit doubtful. How do I go for it? Don't worry. We have given a link below the description of this video. In the description, click that link. You will be downloading a simple Excel file. This is not a rocket science. Very simple Excel file that will have specific data where you key in. It will tell you how much you have to invest monthly to meet that particular goal. The downloaded Excel sheet will look like this. Though this is children's marriage dream cost calculator, you can use this for any financial goal. Let us say like you want to buy a car or property for anything. So in this case, for your children's marriage, 25 lakhs is the amount, right? Only in the yellow color column you can give input. In the yellow color column, what is the children's marriage cost? Let us say the marriage cost is 30 lakhs, right? And how many years left for children's marriage? Let us take it as 15 years from now. What is the expected inflation rate? Inflation rate is, let us say, 6%. And interest rate expected from investments, let me take it as 10%. It gives you clarity. See, dream cost adjusted with inflation. Though you need 30,000 rupees, at 6% inflation, after 15 years, you will need 71 lakhs 89,000. 71 lakhs 89,000 is what you need 15 years from now. To achieve that amount, if you could invest 17,347,000 rupees on a monthly basis at 10% yield giving investment, you will be able to achieve this. So if you input all these 4 factors, it will throw what is the total corpus needed, how much you have to invest on a monthly basis. Suppose your investable surplus is not having 17,000 rupees or whatever the resulted monthly contribution you have to make. Though the amount may say like you need 50,000 rupees per month to be invested to meet your goal, but you are comfortable investing only 40,000 rupees now. You have a deficit. No worries, start with 40,000 rupees. Over a period of time, you can do more additional investments. You can increase it to 50, 60, 70, like that. You will be able to increase it to meet this particular corpus. So this particular Excel sheet will definitely give you clarity on where you have to start investing actually. What is the future value of your goal and what is going to be the monthly contribution you have to make in order to meet your goals. All those things will be easily calculated by using this Excel sheet. Please download this Excel sheet in the description of this video. Okay, now you are clear how much to invest. Where to invest is a question mark. All right. This slide, if you look at it, this will give you clarity. This will help you decide between schemes to invest based on number of years you have to achieve the goal and also what kind of risk appetite you have got. Let us take the column. First, take the low risk column. The low risk column, if your time horizon is 1 year or less, then FDs, RDs, overnight fund, liquid funds are suitable to you. Generally, overnight funds and liquid funds will give you closer to your savings bank account rate of them. Maybe 0.5% or 1% higher than your savings bank rate, maybe 4.5% kind of return. Medium term goal, FDs would be a better option. And for long term goals, again, you are a low risk, complete risk averse investor. You can go for PPF. Remember, PPF has got a lock-in period of 15 years. Though there are partial withdrawal which is available earlier, for a low risk or no risk investor, these are all the investments available, both for short term, medium term, and long term. If you are comfortable taking some risk, but not comfortable taking like too much of risk, you want to be very conservative, then in that case, for short term goal like 1 year, you can go for ultra short duration. And as a medium risk investor, for medium term goals like 2 years to 4 years, you can choose short term debt funds. For your long term goal as a medium risk investor, you can choose balanced funds. Balanced funds invest both in equity as well as in fixed income schemes. So they come under a hybrid category. They can give you inflation meeting, at times inflation beating returns. If you are a high risk investor, for short term and medium term, you have to pick and choose the same set of schemes, right? Because your time horizon is short term. So choose ultra short duration fund or short term debt funds only. There is no special scheme for a high risk investor if you have a short term goal or a medium term goal. But if you are a high risk investor, then for your long term goals of more than 5 years or more, you can invest in diversified equity funds and direct stocks. So this simple slide can give you clarity on where to invest. Let us not confuse with other complicated structured investments like ULIP, cryptos, alternative investment funds, capital protected schemes. Let us not fall prey for those kind of schemes or some scams. Let us not fall prey. Focus on these kind of investments which I have listed here. The schemes which I have listed are completely regulated, well-regulated schemes. So this will give you a fair amount of idea where to invest for what kind of goals based on the time frame and your risk appetite. Right. Now we have looked at what is going to be your contribution you have to make on the monthly basis to meet your goals. Then what kind of schemes to select, we have discussed. There is another important parameter which is important in deciding any investment is what kind of qualitative parameters to look at or what kind of things to avoid and what kind of mindset to have as an investor. Number one is like having money to invest, how much money to invest and where to invest. Number three, with what mindset I have to invest. That is very much important. So the next few slides, we will look at what kind of mindset to have. As an investor, You have to focus on return or focus on risk. Many a times investors focus on return. I would say people over focus on return. When they go over focus on return and chase return, there is a high probability they will end up meeting the risk. If you go to a bank says for 3-year FD we are giving 5% rate of return. Another bank claims for 3-year and 1-day FD we are giving highest rate of return, which is 5.05. Company deposits will claim they are giving higher rate of return than bank deposits. Mutual funds will say we are giving higher rate of return among all other mid caps. Stock brokers will say you buy this stock at 250, in 3 weeks it will touch 300. The entire game of things, what is focused is the return. What goes unnoticed is risk involved in these schemes. So as an investor, you have to focus on risk first, and you should have right strategy to manage risk so that you can end up meeting above average consistently. Focusing on risk, managing risk will help you take calculated risk. Taking calculated risk will help you reduce your downside risk and increase your safety now, margin of safety. So that way, as an investor, don't get carried away by the return. Also, equally focus on the risk factor involved. And most of the times, if you look at it, these kind of news like gets the limelight. Okay, a scheme in which someone has invested 27 years back, 1 lakh invested has become 1 crore. Right? This has happened in many investments. It can be in a single stock, it can be in a mutual fund. 1 lakh invested has become after 27 years, becoming 1 crore is possible. Though it looks a very good number, definitely it is a very good number to achieve. This is what captures. Okay, Franklin India blue chip, HDFC Bank share are achieved like these kind of returns. This is what we see. We immediately search for what is the next blue chip fund, what is the next HDFC Bank kind of stock. This is what we think about it. But what we have to actually pay attention is, as an investor, to make 1 lakh to grow to 1 crore, they have stayed in the market. They have endured multiple recessions. Right? In the year 2000, there was technology bubble burst. 2008, subprime crisis. 2020, pandemic. But if that investor has stayed, he would have got 1 lakh would have become 1 crore. Political instability every 5 years, at times even in a shorter span of time, government changes. Regardless of that, people have to stay. But headlines will create a lot of pressure on you. Post-government, post-budget analysis, pre-budget analysis, post-election, pre-election analysis on the stock market. All those things may either inject greed or inject fear. We should not get carried away. Similarly, like sudden market fall. In the year 2008, market fell by close to 60%. In the year 2020, market fell by 38%. This should not dishearten us, and we should not move out of the market. So, as an investor, you have to stick to the market for 25 plus years to convert 1 lakh into 1 crore. It is possible. So, instead of paying attention to the media news, read between the lines and understand the mindset to stay the course. First, you should have conviction on your investment. So before investing, understand how it performs, what kind of risk it can give you. Right? That understanding of the risk level in the investment will give you conviction. That will give you patience to stay the course for 5 years or 10 years or 15 years. Then, as an investor, focus on things which you can control. You should not focus on things which you can't control. GDP, because of that, market is going to become green or become red. Foreign policies, how it is going to affect IT sector. Election results, how it is going to impact like a particular group of companies. Macros, like other market sentiments. So these things can influence the market temporarily. Will these news will matter 10 years from now, 15 years from now, 20 years from now? And also what you have to understand is these things are not under your control. So focus on things which you can actually control. How much you can save, what kind of asset allocation to have, do I have enough discipline to invest on a monthly basis, right? How can I create a balanced mindset instead of like having a greedy mindset or a panicky mindset? Have a balanced mindset. How do I have it? These things are under your control. You can work on it. So first, control the controllables instead of focusing on what is not under your control. Don't take any decision based on things which are not under your control. Things which are not under your control, whatever the decision you make, they can change. Macros can change anytime. Focus on facts and reasoning, not on media views, expert views, or insider views. Before you make the investment, you do all the analysis. If you are investing in a stock, check what is going to be the profitability, what is going to be the sustainability, what is going to be the capital efficiency, whether this particular company is easy to disrupt or not, management quality, all those things you check and then take a decision. Don't simply get carried away by media views, expert views, or insider views, right? You have to focus on actual facts and reasoning behind it. Don't just give overweightage to others' views. Then another important tool is allocation rebalancing to reduce the risk. Again, we will be seeing this in the subsequent episodes in detail. Don't invest all the money in one particular asset class, divide it. If someone would have come to me with like 10 lakhs in 2019, I could have told them, if they are an aggressive investor, I could have told invest 70% in equity and 30% in fixed income. That 70% is staggered for 1 year and invest. They could have invested 7 lakhs in equity by end of 2019. In 2020, market crashed. Because of that, 7 lakhs could have become 4.34 lakhs. That could have remained as 3 lakhs, or it could have appreciated relatively to 3 lakhs 15,000. If you look at the ratio now, initially was 70-30. Now, because of the crash, equity has come down. The ratio is 60-40 now. Now, withdraw close to 80,000 rupees from your fixed income and add it in equity. So, when the market is at the bottom, available at a discounted rate, you are investing more money, not the entire money, some portion of that you are investing. You are able to have better average rate. Because of that, your portfolio will be able to recover faster than the portfolio which was not rebalanced. Similarly, in October 2021, when market touched all-time high, again we will do rebalancing. Because of that, you will move money from equity to debt. Subsequently, when the market crashes, you will have lesser impact. So this allocation rebalancing you are able to do without looking at macros. Simply looking at your portfolio. This 70-30 is what you have to maintain. Rebalance it. Simple. Don't pay attention to media views, macro news, because those things change. This 70-30 is fixed for you. When this 70-30 is sensibly getting dislocated, rebalance it. When you have these kind of best practices in your investment plan, you'll definitely on the right track to achieve your financial goals. It will be much easier to achieve your financial goals. We will see more about achieving your financial goals in the subsequent videos as well. Hope you like this video. If you have any questions on this video content or any questions on achieving your financial goals, feel free to book a free appointment with our certified financial planner. To book the free appointment with our certified financial planner, I have given a link below this video in the description. I have also given one more link in the description to attend our free webinar. We regularly organize insightful investment webinars. So if you want to participate in those webinars, please leave your name and email ID below this video in the webinar link. I will book the seat and share the link to you. It is completely a free webinar. Eminent investment experts will address the forum. They will share their unique investment strategies and definitely very impressive, proven, tried, tested long-term wealth creation strategies that you will be able to implement immediately in your portfolio. So please participate in our upcoming webinar. Hope you like this video. I'll again meet you in yet another useful video.